Our next guest is holding her year-end target for the S&P 500 at 4,000. That's down slightly from yesterday's close. She also maintains that small caps are still more adequately priced in terms of risks of a mild recession. For more on the markets and the earnings season so far, let's bring in Jill Carey Hall. She's the head of small and mid-cap strategy at Bank of America Global Research. Good to see you this morning.
Thanks for having me.
You think the small caps are actually accurately pricing in what you think is most likely to happen?
I think that they've been pricing in the risk of what everyone's expecting, maybe not everyone, but what most investors are expecting now, which is a recession. And we are expecting a mild one. I think, for small caps, we did get tactically cautious in mid-March amid everything going on with some of the regional banks. Small caps do have more credit sensitivity. They do have more exposure to banks. So for the near term, we've been cautious. But I think if, we avoid a major credit crisis and we see more of the mild recession that we're expecting, then I think the longer term case for small caps is still intact. They're, bigger beneficiaries of CapEx spending staying resilient. They're bigger beneficiaries of services spending staying more resilient than goods spending. And they're trading at, near record low multiples versus large caps, which valuation isn't super predictive over the short term. But, if you have a multi-year time horizon, we think longer term it could be, a good environment to overweight small caps. So tactically cautious, but longer term, we think the case is intact.
Okay, so the case being intact, what would change your mind? What do you think as you look through the earnings season so far? Just what you hear about the economy at this point and what companies are actually expecting for the full year? Sure.
Well, I think, small caps are certainly more economically sensitive. And on one hand, they have been pricing it in. Small caps are very correlated to the ISM, manufacturing index, but they're pricing in about 41, so below current levels. I think, we do see more downside risk to earnings estimates across the market. And, the earnings backdrop, we're going to be paying close attention to guidance this earnings season. It's still pretty early, especially for some of the smaller companies, which have yet to report. But, early reads on S&P 500 guidance have actually held up, better than expected. So, I think that's one thing we're going to be paying attention to. I think, a longer term risk to smaller stocks and overall for corporates that have more leverage is that, if we do see a backdrop where interest rates rise again, the smaller companies do have more leverage and more shorter term floating rate debt. So that is a longer term risk to smaller stocks if they need to refinance, some of that coming due several years from now.
Okay, let's just take about risks in terms of, things that we know could potentially get worse, like the banking sector, things that have gone through the credit crunch. How does that potentially impact things?
Well, I think overall, we're in an environment right now where with the market, especially going into this summer, could be volatile. But near term, our view on the market is that positioning has gotten very, very negative. We've seen cyclical sectors in general. Active funds have purged their positioning in these areas relative to defensives. Investors have reduced allocations to equities relative to bonds. So our view for the near term is to stay invested, to favor cyclical sectors for the quarter. I think as we mentioned, we've been more neutral on the market overall. Tactically cautious on small caps, but longer term, this is an area that we could see more upside than for larger stocks.